Welcome to Moneycontrol. I'm your host Nickey Mirchandani, and you have tuned into IPO Watch. Today we are going to be talking about Zaggle Prepaid Ocean Services, yet another IPO which is coming up for subscription on September 14th. The fintech product and solution provider plans to raise around 563 crore. Of this issue, around 392 crore would be for fresh issue, and offer for sale would be aggregating up to 171 crore. Ashish Kacholia, along with Kela family, is one of the investors in the pre-IPO placement of the company. But to talk more about the company financial strategy, model, projections in terms of the financials, we've been joined by Avinash Godkhindi, the managing director and the CEO of Zaggle Prepaid Ocean Services. Evening there. How are you doing?
Very good, Nikki. Thank you so much for having me on your show.
Pleasure. I'm just going to straight up ask you about what does the company do? It's a differentiated fintech player, which is sector agnostic. Talk about your business, talk about your clients, markets, and the segments essentially where you operate.
Sure, Nikki. So if you look at any company, we have more than 2,400 corporate customers today, companies like Persistent Systems, Tata Steel, Greenply, Hiranandani, Aon, and all these companies incur expenses, right? Expenses can be classified into three broad buckets: employee spends, channel incentives for dealers, distributors, retailers, etc. And then you have vendor payments. What we do is we offer a SaaS platform, a technology platform to digitize all these spends, to bring all these interactions between the vendors, the employees, all their bills, their invoices onto a single platform, a single dashboard, and a single mobile app, and marry it with payment instruments. Payment instruments could be prepaid cards. We have about 16% of market share, as per the Frost and Sullivan report, of the prepaid cards issued in India in partnership with partner banks. We partner with a whole host of banks like Yes Bank, IndusInd, uh, even ICICI Bank, NSDL Payments Bank, and DBS. And we do corporate credit cards. So we have co-branded corporate credit cards with banks like Yes Bank. So we marry the software, we marry the payment instrument, and we help companies digitize their spends.
Sure. Let's understand the size of the business that you operate in because there are no listed players within the space when it comes to at least India. And what are the key entry barriers within the industry that you function?
So look at it this way, Nikki. If you look at the fintech space and digitization drive that's currently happening worldwide, and especially India has taken a lead in this. The opportunity to be able to digitize spends is massive. You got global players like Brex, Ramp, Pleo, FleetCor, Rex, Edenred, which are multi-billion-dollar companies. Many of them are listed in the US and elsewhere. And spend management is rapidly growing in India as well, because Indian companies also need to be able to track their expenses. They need their employees to be able to very easily, seamlessly, submit their expense claims through a mobile app, look at it through a dashboard. And this space is rapidly growing. If you look at our size today, our revenues for the last financial year were about 553 crores. And I'd like to highlight that we are one of the few profitable SaaS fintech companies. We were profitable at a PAT level for the last 4 years.
We get on to that segment-wise breakup too that I have, but let's first get the basics out of the way. Proceeds will be utilized for what? 300 crore of from the proceed is also going to be spent for customers and retention costs, right? How for how many years this amount would be used for or would be useful for? Your could you provide some color on this?
Definitely, Nikki. So this is spread across 3 years. And one of the key things that we do is when we engage with a corporate customer, we try and make sure that the users of the platform uh, are habituated to using the platform and they do it happily. To be able to change their habits, to get them to start using the platform, we use these incentives. There's a fairly sophisticated algorithm that runs in the background to figure out who should be incentivized. It's discretionary, and to what extent should those incentives be provided. And using that algorithm, we go ahead and provide these incentives to select users.
All right. So the proceeds Also, since it is earmarked for customer acquisition and retention cost, just wanted to understand for how many years this particular amount can be used for, and what kind of fundraising will be required further for that. Just give some perspective. Would
Yes.
that be from internal accruals? How are you looking at it?
So this 300 crores is allocated across 3 years, right? And if you look at our last 3 years, our incentives, which is the line item which corresponds to this expense, uh, that has gone down steadily. So it was 140 crores in FY21. In FY22, it was 118 crores, and in FY23, it was about 101 crores. So that's the line item that this corresponds to, and that's something that we are very consciously using fairly sophisticated algorithms to optimize.
Sure, let's get on to the financials before we get into the further dynamics of the acquisition versus the retention and the overall revenue profile. But let's understand more on the financial part, where the revenues have almost doubled from the period of FY21 to 23. 239 crore goes to 553 crore. But if you look at the margin profile, that's where the concern is around. 11.5 in 2021. And now, if you look at the financials for 2023, they've shrunk to around 8.7%. A, what explains that, and what can be expected going forward?
Great question, Nikki. So if you look at why this has happened, that's important, and that was something that was fairly carefully studied by all our investors who evaluated the offer, including you mentioned Ashish, the Kela family, Value Quest. So there are a couple of key reasons for this. One, in September 2022, when we were fairly clear that we would want to go ahead and try and do an IPO, we decided to issue ESOPs to all our employees. Right, so each and every one of our employees, from the junior most person to the senior most person, was given ESOPs. So there's an ESOP cost that we have incurred in FY23, which was not present in FY22. This cost tapers is projected to taper over the course of the next 3 years. It's going to be reasonably significant for FY24, and FY25-26. It's projected to taper down. Right? The other reason is that we expensed out the full investment that we made in our corporate credit card business. So we invested significantly to build our corporate credit card program, the platform itself, as well as our accounts payable platform called Zoyer. And we have taken an expense around this as well. So these are investments for the future, which we have expensed out in FY23.
Right, Avinash, in that case, your EBITDA minus the ESOP, what does that number stand to in FY23, and what do you expect it to grow on to? I mean, for the next 2 years or 3 years on steady state basis, what is the kind of margin growth can the company look at?
So the EBITDA is about 48 crores, and the ESOP expense was about 14.5 crores, Nikki.
All right. What is the kind of projection that we're looking at in terms of the margin profile on steady state basis for the company?
I'm afraid, as much as I would like to share that with you, Nikki, I'm bound by the SEBI rules.
Are you looking at a double-digit growth in the margin profile?
I wouldn't want to make any forward-looking statements, Nikki, but look at this way. This space, every company requires digital solutions. They need to digitize their spends. They need control. They want to prevent leakage. They want to increase their efficiency. They want to be more compliant. They want all that information on the cloud, so that at a click of a button on a dashboard, they can see why was a particular expense processed for a particular employee or vendor, who approved it, what was the basis, how do their costs look across different project codes, cost codes. These are pieces of information that come to our platform from their ERPs, and we have API integrations with their ERP solutions. So these are fairly universal needs. And coupled with that, the great tailwinds that we have in India, whether you look at demand, GST, COVID, the acceleration is very rapid for these solutions. So without going into the specifics, I'd like to highlight that the opportunity in this space, and the fact that we are a leading spend management player in the country. We don't have any like-to-like peer per se.
Sure, I get that point straight up. But let's talk about your revenue mix. The change that is played through FY21 to 23, from little that I could pick up from the RHP, program fee contribution came down to 30.6% as compared to 81% in FY21. So there is a 50% almost decline there. The gift card revenue grew from 13% to 65%. And
Correct.
SaaS fee, where you said that it's a profitable area, only profitable venture out there, more or less the contribution from that segment, correct me if I'm wrong, has remained pretty much same. How do you intend to change that mix? A, and if yes, the bend would be in which segment? Where would be
So,
the focus?
so Nickey, just to highlight, we are profitable across board, across three segments. And we are a very frugal, cost efficient, bootstrapped, and profit focused company. And you can see that from the numbers. And this was a very conscious decision to reduce dependency on program fees. We wanted to broad base our revenues, and we ramped up our SaaS revenues as well as our revenues that we get from Propel Points, which is our points platform. A points platform, just like the points that you get on your credit card and then you redeem these points. Our points are points which are issued by the corporate, the enterprise customer, like a Tata Steel or a Persistent Systems, to their employees or their channel partners. Right? And they redeem these points for two purposes. They could either redeem it for vouchers of over 300 brands, in which case that gets recognized as Propel Points revenue. Or if they spend it on a network card is in a RuPay, Visa, MasterCard product, then it gets recognized as a program fee. So it was a conscious attempt to reduce our dependency on program fees, especially interchange on prepaid cards. Now with the launch of corporate credit cards, we'll see program fees grow. We are seeing that. We'll see all three lines of revenues, do well in the coming years, hopefully.
Sure, I mean that's always the case, right? But in that case, program fee, do you think you're going to be focusing more on program fee with this? Are you expecting more revenue mix coming in from that segment and gradually up it, or are you still going to be focusing on your gift cards, or maybe perhaps even SaaS fee for that matter, which has remained stable, flat perhaps? How are you looking at it? Where is the focus going to be within the three segments?
So, Nickey, we focus on our corporate customers, we focus on our users. When I sell a software platform to my corporate customer, along with that software platform, I sell a payment instrument, right? So I'm not selling a single solution. And when I earn more SaaS fees, I'm most likely to earn more program fees or more income from Propel Points. So it's not that you earn either from software or transaction, you earn from software and transaction. And that's the beauty of the model. It's a tight coupling between a software platform with a payment instrument. So it's actually a focus to be able to make sure that the corporate customer and the employee or the user of the corporate has a holistic solution, because people are totally fed up of multiple apps, multiple dashboards, multiple Excel sheets, multiple cards. They want a single platform, a single login, where very simply they can see how much am I spending for my employees, how much for my channel partners, how much for my vendors. Within my vendors, how much of it is coming for my travel expenses. Break it down, locations, geographies, project codes, cost codes. So all the cuts that you can get on the data through a pie chart and a bar graph, and that's what our platform is able to provide.
Sure. So the revenue mix in that case remains the same.
See, I wouldn't be able to predict how the revenue mix would be, but our intent would be to.
At this point of time, let's just put it differently. At this point of time, which of the three segments which one is more margin accretive?
See, obviously, when you look at the margin profile, gross margin profile of the three lines of revenue, SaaS has the maximum gross margins, followed by program fees, which is also very high. The Propel Points number, actually, as per Ind AS rules, is a gross number. So for the revenues that we recognize, so let's say an employee of a company like Persistent Systems is issued 10,000 points, and she redeems those points for a voucher of a brand like, say, Shopper Stop or Amazon. Right? And so we recognize 10,000 rupees as revenue, and we take, say, 9,000 rupees as the direct cost. That's the cost that we incur for a voucher of face value 10,000. We pay the merchant or a third party 9,000 rupees for the same voucher because we are driving footfalls and spends. So basically, our margins or take rates there are 10%. So margin wise, it's good, but here we need to take the gross numbers as per the Ind AS rules, accounting rules, Indian accounting rules.
Sure. Avinash, could you provide more color as to how profitable is SaaS as compared to a program or gift? Just to get a little more perspective of how can one look at the particular business model when it comes to the financials of the company.
Sure. So if you look at it, Nickey, as I mentioned, in vast majority of our customers, we earn at least two of these three lines of revenue. Okay, because I'm offering the software, and along with that, I'm earning on the transaction. I'm not typically, there could be one-off cases where I'm only offering the software, but typically I'm offering both the software and the transaction. Now, coming to how the margin profile looks, in software, we've already expensed out the cost that we have incurred to build these platforms. Hence, the margins are much higher in the software side. Having said that, these are numbers that obviously
SaaS.
vary.
When you say software, you mean SaaS, right?
Sorry, I didn't catch that.
When you say software, you mean SaaS, right?
Yes, I mean, yes. When I say software, I mean SaaS. Absolutely.
Okay. So, what's the margin within the picture? How much is the SaaS contributing towards the margin? Just get that out of the way.
So last year, if you look at our revenues, out of 553 crores, our SaaS revenue was about 24 crores.
That's your revenue, right? How about the margins?
So you're talking the gross or the net?
I'm just talking about EBITDA margins in general.
EBITDA, I would say contribution of a SaaS per se would be fairly high. Again, we don't segregate it in that way, Nickey, because it's not as if we have a separate team which is building software and there's a separate team which is building the tech for the transactions. It's a combined unit. So we don't necessarily measure it this way, that how much are my margins, EBITDA margins coming in from software. But obviously software, because a lot of the expenses are historic that we have invested in building the software platform, so the margins are higher.
All right, let's also understand your average acquisition cost per customer grew at a CAGR of 58%, while from FY21 to 23, while the average revenue per customer grew around at a CAGR of 2.5%. Have I got that right in terms of CAGR? What explains that, and what can be expected going forward?
See, if you look at this business, Nickey, our churn rate is less than 2%. Okay, so we don't lose customers. Customers take time to fully blossom as an account, because you're talking of enterprise accounts, and it takes about 3 to 5 years for an account to fully fructify in terms of the revenue potential. And hence, when you're adding customers rapidly, while you're investing a lot in acquiring those accounts, the revenues that would be generated from those accounts takes a while, about 3 to 5 years to come through, because you're earning through a recurring mechanism, right? Whether it's the SaaS or the transactions, your cost to acquire the corporate and the user is upfront, but your revenues are going to come over the course of 3 to 5 years, which is the duration of our contracts. Many of our contracts are also auto-renewal.
All right, Avinash, I think we're just going to leave it at that. And thank you for taking our time and speaking to us.
Thank you for this opportunity, Nickey. It was a pleasure speaking with you. Thanks. Bye.
With this, it's a wrap. Thank you so much for tuning in.